Hi there. In this video, I will walk you through a real Broadcom core calendar trade and how active position management shaped the final outcome. My name is Gery and I'm the Chief Options Expert at TanukiTrade. The original idea was to capture a sideways, slightly choppy move inside the positive GEX environment using a Friday-Monday calendar structure combined with downside hedge protection. The expectation was controlled price action around key reaction zones like HV output support and core resistance. However, the market quickly became unstable, volatility expanded, and price moved against the original plan multiple times. Through scaling out, adjusting data exposure, and actively managing the hedge component, the risk profile changed significantly during the life cycle of the trade. One of the key lessons here is that calendar spreads combined with hedges can behave very differently near expiration, and without active management, this position would have turned into a loss, even though the price eventually returned close to the original entry level. Instead, structured adjustments allowed the trade to finish with a solid profit despite adverse conditions. So let's get to the video. In this video, I would like to show you a new position that I have just opened for Broadcom. Here what you can see is a daily chart of Broadcom, and we are just above the HVL line, which is the high volatility level. We are in a positive GEX environment, and the market bounced back from the 310 put support, and there is a core resistance or core wall, the highest core wall at 350. And I think that the market might gyrate back and forth around these levels, can be a little bit choppy. Below the HVR, it's usually choppy with a higher volatility. And I think that the market can move sideways. And that's why I was looking for a spread that never existed before, because this is a pretty new construction, because they introduced the Monday, Wednesday, and Friday expirations for a couple of tech stocks, namely Broadcom as well. So I was looking for the Friday, Monday expiration. This is the Friday and this is the Monday. So Monday never existed before. Friday, obviously, yes, because those are the regular standard weekly expirations. So I was looking for a 350 around this area as the core calendar side, this side of the spread, and the hedge protection on the downside, put vertical spread. And the ratio between the two is 1:3. And right now, this is still negative delta, which is not as good as I want to have, but I still wanted to have a higher hedge on the downside. And if you look at the Thinkorswim analyze graph, you will see that if the market crashes, I will lose around $18, which is kind of okay. Compared to the debit I have to put into the calendar spread, so I'm not always shooting for a maximum or total hedge on the downside, but some kind of a protection. And if the market goes pretty fast to 350 or 360, it will lose money, obviously. But if it's just moving around this area, then probably it will be a good trade. And with time, it will become more positive in terms of data, because that's the effect of charm, the time decay or time change for data. And let me show you the screenshot of my fields. Here are the fields. These are the debit spreads for the put protection, and this is the calendar spread on the upside. So this is how the position looks like right now. Let's continue from here. It's Thursday, and we can see on the daily chart of Broadcom that it went below the HVL line. And the put support that was previously 310, it's now 300, and this was also higher at 350. Now it's 340. And also the core pricing skew decreased, and the IVR increased, and also the implied volatility increased. So it's kind of a bearish sentiment in and of itself. After the market filled this gap, went a little bit higher than rejected, and now it's turning back down. It's not the cause of Broadcom. The whole market is down. The SPX is 1.5% down. The VIX is around 20% up. Microsoft earnings was really bad. It's down for 12%. So the whole tech sector is down. And that's why I wanted to readjust the position a little bit. And if you look at the position, what I did is scaled out 1/6 of the calendars, the core calendars for 350, because they are pretty far from this level. So I just cautiously sold 1/6 of it because I wanted to have a lower delta. Right now it's 4 delta on the upside, and by scaling out a little part of it, it went down to 2, 1.5, whatever. So I just wanted to close one part of the position and make the delta more neutral and more flat. If the market is tanking, I'm okay with it because it will make money because of the hedges. If the market turns around, that's also fine. What I need to watch is the value of that in here and how it will sink, because it will. Because the calendar spreads on the upside will lose money as time progresses and the market is not moving against them. So that's why I have to watch these values, because I still could close a little bit above where it was originally opened. So this is the thing. And I forgot to mark where I opened the position on the chart, but I made it here. Open was the 27th of January, 2 days ago in this candle, and the market turned around very quickly. That's why it's good to have some kind of hedges in a very crazy market like this that can change direction every single day. So that's why it's good to have like these put vertical hedges. And right now, this is the current state of the position. I will continue from here. We are on a Friday now, and yesterday we had a big red candle which recovered by the end of the day. Right now we are around this HVL, and what has changed since yesterday is that 400 core resistance became the biggest one. Yesterday it was around 340. What I decided is scale another 1/6 of the position for $70 and still playing with positive data. This was the original one before the adjustment, and with the adjustment I have around 1.5 delta, so it's a positive delta. If the market shoots up quickly, that's a problem here, but if it's not, then it can make more profit. But if the market crashes, I will not lose. If the market stays here, the value of that will dip even lower, because the expiration is next Friday, so I have to watch for this happening. And here is the screenshot of the fill. 0.70 was the credit for selling another portion of this calendar spread on the upside, the 350. And if you look at the 350, it's here, the next core wall. So if the market can hold above the 330 HVL, might be a possibility to go back up. But the big picture shows us that there was this kind of gap fill down here, and the market is gyrating around this area. So I'm not seeing any violent bullish signal in here, but I can see kind of a zigzag around this area, which can be better if it's around the 10th. If it's staying here, that's a problem. So I have to take care of this. I will continue from here. It's Monday, and what we can see is that the market is really dancing around this HVL level. Right now we are just a little bit above HVL, so it's a positive GEX zone. And the position has 4 days until expiration, so I decided to close another part of the original core calendars. 1/6 of the calendar was closed for 75, so before my adjustment it looked like that. After the adjustment, it's a little bit negative data, which will change with time. So if market shoots up, then shoots up very fast, then it's a problem. But data or time will decay with delta. So if the market goes really fast and sits around this area, the delta will turn to positive. And since there is a core resistance at 350, I'm not afraid that the market will shoot just very violently above that. So that's why I don't care, or I'm not worried about the minimum negative delta at this stage. And here is the feel from my execution on Trader. And this is how the position looks like now. And I will have 4 more days until expiration. Let's continue from here. It's Tuesday, and we have a very bad day in the market because everything is falling. The VIX is around 20% up. And as you can see on the daily chart of Broadcom, there's a huge red candle on the downside. And what we can see is that this gap is already filled, and the 200 moving average is very close. And also the 300 Broadcom put support is pretty close to that. So that's why what I decided is closing down the vertical hedge position for 205. Remember, I bought it for 115 because I think there is a possible chance that the market might turn around hitting these confluencing levels. I'm not sure, obviously, but I wanted to take profit on the hedge itself. So this is how the position changed. And I remember I did both. I mean, I sold both of the hedges. What I could also do is only sell one part of the hedge and make like that. But I wanted to close both hedges. And I still have a couple of lottery tickets for Friday for $3.50. They were at 22 cents, and this is the target price. It's pretty impossible to reach that for Friday or until Friday, but who knows. So since the position has absolutely no risk in it because of the hedge, the worst thing that could happen is I make $87 at expiration and the whole thing expires worthless. But if the market bounces back from these levels, I might make a little more money than that. So I still keep these positions open, and let's see how the market behaves in the next couple of days. I will continue from here. It's Thursday, the 5th of February, and what we can see on the daily chart that there's a relative strength or power for Broadcom because it has jumped back from the 200-day moving average, and the whole market is in a falling spiral. The VIX is around 20% up, the SPX is around 1.5% down, but still Broadcom is fighting the trend because it's moving up from yesterday. It has filled the gap. We are a little bit above the put support or the highest support level, but still below the HVL. So right now what I did is scale out from 1/3 of the position. Here you can see that I scaled out from this part of the position for 40 cents. The original was 48, so I made a loss on it. But still, the whole thing is up money. And I left a very small portion of the position for tomorrow. If the market decides to turn up to 350, it's a little bit unlikely, but, you know, never say never. So that's why I left it open. And here you can see the screenshot of the fill from the live trader account. And the worst case is that I make $167 as a profit. And the best case that the market goes to 350 tomorrow and this whole thing can blossom and make a lot of money. We will see tomorrow. I will continue from here. It's Friday and we can see that the whole market is rallying, especially Broadcom, because it's almost or above 7% gain just today. Again, above the HVL, but we are still not getting to 350. So since this is the expiration day, I closed out the remaining position. And you can also see that this nicely jumped back from the 300 put support and also the 200-day moving average. And here's the current position, and I could close down the last portion of the calendar spreads for 0.40, so it's for 40 cents. And the total became $207 as a profit. Now just an experiment or exercise. Let's see what would have happened if I did nothing. And this is the dangerous part of having a calendar spread with a hedge, is that if the market happens to stay between the hedge and the calendar spread, value of that becomes very violent, being close to expiration. Right now what you can see is that if I did nothing, this would be a $250 losing position, because this is out of the money, the vertical is out of the money, and also the calendar is out of the money. So it's very important to manage and scale out from a position where you combine a calendar spread with a vertical hedge, because if the market stays between those, this can create a huge loss, and this loss cannot be seen when you open up the strategy. If you go back to the beginning of this video, you will see that this value of that is not existing. You don't see it. You only see it at expiration, and you see it when you are experienced and you know how these behave and how these change with time. That's why it's important to scale out from these positions. But I did, and that's why this is the reason of this series, to show you how I trade with options and what are the best practices. If you look at the chart, it's also interesting to see that I opened the whole position here, went against me a lot, and right now we are exactly at the same place where I opened it, and still I made money because of the scale out and because of the management process. So I hope you gained some insights and new tips and tricks from this video. If you have any questions, feel free to ask. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.